Today we'll have a look at one of the key economic indicators, the Purchasing Managers' Index or PMI. Understanding the PMI can be the difference between a successful trade and a missed opportunity. But what exactly is the PMI and how does it impact the forex market? Let's take a deep dive into this matter. The Purchasing Managers' Index, or PMI, is a key economic indicator that provides valuable insights into the health and performance of a country's manufacturing and services sectors. It is calculated through surveys of purchasing managers across various industries. These surveys assess critical factors like new orders, production levels, employment, supply deliveries, and inventories. A higher PMI indicates economic expansion, while a lower PMI signals contraction. This can significantly impact investor confidence and, in turn, the valuation of a country's currency in the forex market. There are two different types of PMI: the service sector's PMI and the manufacturing PMI. Let's begin by looking at the service sector's PMI. This index is used to measure the economic activity in the service industries such as finance, healthcare, retail, and tourism. Purchasing managers from companies within these sectors respond to surveys about business conditions, new orders, hiring, and inventories, and their aggregated answers make up the PMI, which is reported on a scale from 0 to 100. When it is above 50, it signals expansion in the services sector, usually indicating increased demand, which can lead to improved economic conditions and boost a country's currency value. On the other hand, a PMI below 50 suggests contraction, raising concerns about weakening demand and potential economic slowdown. Now, let's focus on the manufacturing PMI, which measures economic activity within the manufacturing industry, providing vital insights into production levels and the overall economic activity within the sector. Like the services PMI, it is also calculated based on surveys of purchasing managers, but in this case, from manufacturing companies. The manufacturing PMI, as well, is reported on a scale of 100 or 0. A strong PMI suggests that production and demand are increasing, which can lead to a rise in the country's currency value, as markets anticipate a thriving economy. If the PMI falls below 50, it often raises alarms about a slowdown in the manufacturing sector and can lead to a depreciation of the currency. For forex traders, understanding both the services and manufacturing PMI is crucial. These indices paint a clear picture of the economic landscape, highlighting the health of two critical sectors: manufacturing and services. By analyzing the PMI data, traders can gauge overall market sentiment, predict trends, and make informed trading decisions. So, how does the PMI affect other markets, like gold? Well, a rising PMI generally signals economic growth, which often reduces the demand for gold as a safe haven asset, potentially lowering its value. On the other hand, a falling PMI suggests an economic slowdown or recession, which often makes investors turn to gold for stability, driving its price higher. The impact of PMI on the US dollar is also significant. When the PMI rises, it typically signals economic strength and the potential for higher interest rates, making the dollar more attractive, pushing up the dollar's value. Conversely, if PMI falls, it suggests economic weakness and the possibility of low interest rates, making the dollar less appealing, which can lead to a decrease in its value. Strengths and weaknesses of the PMI are also something you truly have to think about. One of the PM's key strengths is its timely release. Coming out monthly, the PMI provides up-to-date information, helping analysts respond quickly to market changes. It also is considered a leading indicator, often changing before other economic data, giving traders an edge in predicting future trends. The PMI offers a comprehensive view of the economy by collecting data across various parts of the supply chain. Plus, it is globally comparable, which makes it easier to assess economic performance across different countries. Its simplicity, with readings above 50 indicating growth and below 50 signaling contraction, makes it easy to interpret. However, the PMI does have some limitations. It is based on surveys from a limited sample of purchasing managers, which may not fully reflect the entire economy. Additionally, the responses can sometimes be influenced by the personal expectations and emotions of those surveyed, potentially affecting the accuracy of the data. The index can also fluctuate due to seasonal factors or one-off events, making it somewhat challenging to interpret long-term trends. And while the PMI covers manufacturing and services, it doesn't provide a complete picture of the entire economy, as it omits factors such as agriculture or external influences. The PMI is not only used by analysts and investors, but also by central banks and other policymakers who closely monitor PMI data. A slowdown in the PMI might prompt them to implement monetary policies to stimulate growth, while a rapid increase could lead to tighter policies to curb inflation. In summary, the PMI is a vital tool for analyzing a country's economic health. It offers valuable information that can help predict market trends and make informed decisions. However, it is important to remember that due to seasonal fluctuations, sample biases, and data revisions, the PMI should be used alongside other indicators for a far more accurate analysis. That's it for today. Thank you for listening, and I hope to see you next time. Happy trading!